quiet revolution, something extraordinary is happening to money, and most people haven't noticed. While you were focused on inflation headlines and stock market swings, a quiet revolution was unfolding. Central banks began competing to build digital versions of their currencies. Bitcoin ETFs accumulated over $175 billion in assets. Stablecoins started processing more transaction volume annually than Visa and PayPal combined. Right now, over 137 countries, representing 98% of the world's economy, are racing to reinvent their currencies. Central banks from Beijing to Brussels are building digital versions of their money. Cryptocurrency has evolved from a niche experiment into a $4 trillion asset class. And stablecoins, digital dollars that barely existed 5 years ago, now process more transaction volume than Visa. The question isn't whether digital currencies will transform banking. That transformation has already begun. The question is, what happens next? In the next few minutes, we're going to explore the three forces reshaping the future of money. Government digital currencies that could give central banks unprecedented power. Cryptocurrencies that major institutions are finally embracing. And stablecoins that are quietly becoming the backbone of a new financial system. By the end, you'll understand why your bank, your savings, and your financial privacy may never be the same. Let's start with the revolution. Governments are leading. Governments enter the arena in October 2020. A small Caribbean nation did something unprecedented. The Bahamas launched the Sand Dollar, the world's first central bank digital currency available to the public. A digital version of the Bahamian dollar, issued directly by the government, stored on your phone. It seemed like a curiosity. It's a tiny country experimenting with new technology. But what followed was a global stampede. Today, 3 countries have fully launched retail CBDCs: the Bahamas, Jamaica, and Nigeria. 49 more are running pilot programs. And the 2 largest economies exploring this technology, China and the European Union, are preparing systems that could reshape global finance. Meanwhile, cross-border wholesale CBDC projects have more than doubled since Russia's invasion of Ukraine. Project Mbridge connects banks in China, Thailand, the UAE, Hong Kong, and Saudi Arabia, creating alternative payment rails that bypass the Western-dominated SWIFT system. This isn't just about retail payments. It's about the architecture of global finance. China's digital yuan is the largest CBDC experiment in history. By late 2025, transaction volumes had reached 14.2 trillion yuan, nearly $2 trillion. Over 225 million digital wallets had been opened. The system spans 26 areas across 17 provinces, used for everything from paying taxes to buying coffee. China isn't just digitizing money. It's building infrastructure for a new kind of monetary control. The digital yuan can be programmed, it can expire, it can be restricted to certain purchases, and every transaction is visible to the central bank. Europe watched and grew worried. When ECB President Christine Lagarde pointed to China's digital yuan as a model worth studying, she touched a nerve. Critics noted that China integrates its digital currency with systems that can restrict citizens based on behavior. The question hanging over every CBDC discussion became unavoidable. Where is the line between innovation and surveillance? In October 2025, the European Central Bank announced it would move forward with the digital euro. ECB President Christine Lagarde urged lawmakers to seize the euro moment, warning that American stablecoins posed a threat to European monetary sovereignty. The target: legislation by 2026, public launch by 2029. The proposed design includes holding limits, perhaps 3,000 to 4,000 euros per person, to prevent bank runs. It would work offline. It would coexist with cash, at least officially. But one major economy stands apart. In 2025, President Trump signed an executive order halting all work on a retail CBDC in the United States, making America the only major country to explicitly reject the technology. The concern? That a digital dollar could become, in the words of several legislators, a financial surveillance tool. This brings us to the uncomfortable truth about government digital currencies. The privacy paradox. When the European Central Bank surveyed citizens about the digital euro, 41% of all comments focused on a single issue: privacy. People understand something that policymakers sometimes gloss over. A CBDC isn't just digital cash. It's a system where every transaction can potentially be seen, recorded, and analyzed by the state. Consider what becomes possible. With a programmable currency, governments could restrict what you buy. They could set expiration dates on stimulus payments, forcing you to spend by a deadline. They could implement negative interest rates that actually work because you coup and withdraw digital currency and hide it under your mattress. Some see these as features, tools for more effective monetary policy, weapons against tax evasion and money laundering. Others see dystopia. The Human Rights Foundation has warned that CBDCs risk enabling sweeping financial surveillance, restriction of financial activity, frozen funds, and seizure of funds. When critics point to China's digital yuan, they note it exists alongside a social credit system that can restrict citizens based on behavior scores. Central bankers in democratic countries insist their systems will be different. Zero-knowledge proofs that verify transactions without revealing details. Offline functionality that mimics cash. Technology alone cannot guarantee privacy. Even anonymized data can be daemonized with metadata. The legal frameworks governing how governments can access financial data vary dramatically and can change. This isn't hypothetical concern. It's why the United States effectively banned its own CBDC. It's why adoption of launched CBDCs has been slower than Hope Nigeria's in era. Despite 13 million wallets, sees 98.5% of them inactive on any given week. People vote with their behavior. And so far, they're voting for alternatives. The crypto breakthrough for years. Institutional investors treated cryptocurrency like a curiosity at best, a speculative casino at worst. Pension funds wouldn't touch it. Major banks kept their distance. The question was always, when will the adults show up? 2025 was the year they arrived. By early 2025, spot Bitcoin ETFs had accumulated over $65 billion in assets under management. BlackRock's iShares Bitcoin Trust became the most successful ETF launch in history. Pension funds from Wisconsin to Australia began adding Bitcoin to their portfolios. The numbers tell the story. Bitcoin accounts for 54% of the $3.7 trillion cryptocurrency market, up from 38% in late 2022. Institutional cryptocurrency adoption has become so mainstream that 43% of financial institutions collaborate with crypto custodians, up from 25% just 4 years earlier. What changed? Regulatory clarity, for one. The approval of spot Bitcoin ETFs gave institutions a compliant way to gain exposure without the operational complexity of holding crypto directly. No more worrying about custody, private keys, or crypto exchanges, but something deeper shifted too. When BlackRock, the world's largest asset manager, published a detailed report calling Bitcoin a portfolio diversifier, it gave traditional institutions cover to invest. The reputational risk of holding crypto flipped. Suddenly the question became, can you justify not having exposure? The US government's consideration of a strategic Bitcoin reserve, potentially holding 1 million BTC, sent another signal. If the federal government might hold Bitcoin as a national asset, what does that say about its legitimacy? Visa and MasterCard now support over 75 banks through blockchain-powered payment networks. Fidelity expanded its crypto funds to $2.8 billion in assets. Charles Schwab, Citadel Securities, and Fidelity launched an institutional crypto exchange. The infrastructure for institutional crypto is no longer coming. It's here. The pace is accelerating. Analysts estimate that institutional demand could reach $3 trillion over the next 6 years, while miners will produce only about $77 billion in new Bitcoin supply. That's a 40-to-1 supply-demand imbalance that could reshape the market. The adoption curve isn't gradual. It follows an S-curve. Slow start, rapid acceleration, then saturation. Other asset classes like REITs and international stocks saw 70% of their institutional adoption within 5 to 7 years. Bitcoin's timeline may compress even further due to pent-up demand from years of waiting for regulatory clarity. But the most quietly transformative development isn't Bitcoin or government. CBDCs, it's something that gets far less attention, but processes far more money. The stablecoin revolution, if you want to understand where digital money is actually going, follow the stablecoins. These digital tokens pegged to the dollar and backed by reserves have become the hidden plumbing of global finance. In 2025, stablecoin transaction volume exceeded $4 trillion, an 83% increase from the previous year. The total market cap surpassed $300 billion. To put this in perspective, stablecoins process more transaction volume than Visa in a single year. They've settled more value than many countries' entire GDP. Tether's USDT dominates with nearly 60% market share, followed by Circle's USDC at around 25%. Together, they account for 93% of the stablecoin market. Both are backed primarily by cash and US Treasury bonds, making them, in effect, programmable dollars that move at the speed of the internet, and they're being used for things that have nothing to do with cryptocurrency speculation. In emerging markets across Latin America, Africa, and Asia, stablecoins have become a lifeline. A way to hold dollars without a US bank account. A method for sending remittances that's faster and cheaper than Western Union. A hedge against local currency collapse. 2024 survey across India, Indonesia, Nigeria, Turkey, and Brazil found that many users hold stablecoins not to trade crypto, but simply to access dollars. Tether's CEO noted that USDT has evolved from a trading tool into the most widely used digital dollar in the world. The growth in Latin America and Africa has been particularly striking, 40% to 50% annually in some regions. When your local currency is losing value and your banking system is unreliable, a stable digital dollar on your phone becomes genuinely useful. This hasn't escaped the attention of regulators. The US passed the Genius Act in 2025, establishing stricter requirements for stablecoin reserves and transparency. Europe's MiCA regulations forced exchanges to delist non-compliant stablecoins. Tether announced plans for a new US-compliant stablecoin called USAT. The regulatory framework is catching up because stablecoins are becoming too important to ignore. And here's what makes stablecoins genuinely revolutionary. They work across borders, 24/7, settling in seconds for fractions of a cent. A migrant worker in Dubai can send money to family in the Philippines in moments, not days. A business in Argentina can hold stable dollars, despite triple-digit inflation. An entrepreneur in Nigeria can receive payment from clients worldwide, without the friction of correspondent banking. This is why 99% of stablecoins are pegged to the US dollar, in a world of volatile currencies. The dollar remains the safe haven, and stablecoins have made that haven accessible to anyone with a smartphone. What happens to banks? Here's the question every bank executive is asking. Where do we fit in this new world? A recent survey of 1,700 senior banking executives revealed something striking. When asked about long-term competitive threats, traditional banks ranked sixth. Ahead of them, digital-only banks, big tech companies, fintech firms, and notably central bank digital currencies. The executives see what's coming. The story of fintech disruption is already playing out. In 2022, stablecoin transaction volume reached $6.9 trillion, surpassing PayPal's $1.4 trillion. Real-time payment systems now dominate in countries like India, 83% of non-cash transactions, and Brazil, 49%. Meanwhile, the US lags at just 1.8%, suggesting the disruption is only beginning. Consider what happens if CBDCs gain widespread adoption. When you deposit money in a bank, that money funds loans. The bank pays you interest maybe, and charges borrowers more. This is fractional reserve banking, the foundation of modern finance for centuries. But a CBDC is a liability of the central bank, not a commercial bank. If people move significant deposits into CBDCs, banks lose the cheap funding that powers their lending. The IMF has warned this could diminish the fractional reserve banking system. It's potentially affecting banks' ability to lend and sending shocks through interest rates. This is why the ECB proposed holding limits. This is why every CBDC design includes mechanisms to prevent mass migration from bank deposits. But even without CBDCs, banks face pressure from every direction. Fintech companies have captured significant market share. In 2017, software-based payment companies like Stripe processed about $60 billion. By 2022, that had jumped to $927 billion, rising from 3% to 42% of incumbent volume in just 5 years. Neobanks like Chime, SoFi, and Vero have accumulated millions of users. Robinhood transformed wealth management by eliminating commissions, forcing traditional brokerages to follow. Embedded finance means you can now get loans through software platforms, insurance through apps, banking through retailers. The boundaries between banking, commerce, and technology are dissolving. Traditional banks aren't powerless. They have regulatory advantages, established trust, and massive customer bases. Many are partnering with fintechs rather than fighting them. Banking-as-a-service models let banks provide infrastructure while others handle customer relationships. But the comfortable oligopoly of traditional banking is ending, and everyone in the industry knows it. The new financial order we're re-witnessing something that happens perhaps once a century. A fundamental reimagining of what money is and how it moves. Three forces are converging. Governments are building digital currencies that could extend their control over every transaction. China's digital yuan already processes nearly $2 trillion annually. Europe is racing to launch by 2029. India's digital rupee has emerged as the world's second largest. Circulation grew 334% in a single year, reaching over $120 million by early 2025. The Reserve Bank of India is now expanding both retail and wholesale versions with offline functionality and broader merchant participation. The infrastructure for state-controlled digital money is being built now. Cryptocurrencies have achieved institutional legitimacy. With spot ETFs, pension fund investments, and potential government reserves, Bitcoin has evolved from rebel asset to portfolio staple. The question is no longer whether institutions will hold crypto, but how much. Stablecoins have become critical infrastructure. Processing more volume than major payment networks, they're the bridge between traditional finance and the digital future. They work, they're useful, they're growing faster than almost anyone predicted. What does this mean for you? If you're an average person, the next decade will bring more choices in how you store and spend money, but also new risks. Digital currencies can be seized, frozen, or programmed in ways cash cannot. Your financial privacy may depend on which systems you use and which jurisdictions you trust. If you're a saver, the rules are changing. Interest rates, inflation, and the stability of your deposits all depend on how this competition between government money, private stablecoins, and decentralized crypto plays out. The winner isn't obvious. If you work in finance, the transformation is existential. Banks that fail to adapt will be disintermediated. Those that embrace new technology may thrive. But the comfortable middle ground is disappearing. The billion-person opportunity, while wealthy nations debate privacy and regulation. Something remarkable is happening in the developing world. Digital currencies aren't a theoretical disruption there. They're a lifeline, according to the World Bank's 2025 Global Findex report. 79% of adults worldwide have a financial account, up from just 51% in 2011. In low and middle-income countries, account ownership jumped to 75%, a 20 percentage point increase in a decade. Formal savings in developing economies hit 40% of adults, the fastest rise recorded in more than a decade. The driver? Mobile phones. In sub-Saharan Africa, where bank branches are scarce but mobile coverage is widespread, mobile money has become the primary financial system. Kenya leads the world with 90% account ownership, almost entirely through mobile platforms like M-Pesa. The region saw formal savings jump 12 percentage points in just 3 years. 1.3 billion people remain unbanked. That's more than the entire population of Africa. It's more than Europe and North America combined. People who can't save securely, can't access credit, can't receive payments digitally, can't participate in the modern economy. The opportunity and the stakes are enormous. Of those 1.3 billion unbanked adults, 900 million already own a mobile phone. More than half have smartphones, so they have the hardware. What they lack is the software, the financial infrastructure to connect them to the global economy. This is where digital currencies could change everything. Stablecoins already offer dollar access to anyone with a phone. CBDCs promise government-backed digital money with lower transaction costs than traditional banking. Cryptocurrency provides an alternative for those who distrust their local currency or government. In Nigeria, where the naira has lost significant value, stablecoin adoption has exploded. In Argentina, citizens use USDC to escape triple-digit inflation. In the Philippines, Migrant workers send remittances home through crypto rails faster and cheaper than Western Union. Real-time payment systems are proving what's possible. India's UPI processed over 83% of non-cash transactions by volume. Brazil's Pix reached 99% of the adult population within 4 years of launch. These systems show that when digital financial infrastructure works, adoption can be near universal. The gender gap is closing too. Women's account ownership in developing countries nearly doubled from 37% in 2011 to 73% in 2024. Mobile money has been particularly effective at reaching women. In regions where cultural barriers limit their access to traditional banks, but challenges remain. Only half of mobile phone owners in developing countries use a password to protect their device, raising concerns about fraud and theft as financial services go digital. 2/3 of unbanked adults say they would need help using an account if they open one. Financial literacy remains low globally, with just 17% of adults rating their knowledge as high. And there's a deeper question: whose system will serve the unbanked? If China's digital yuan becomes the standard for developing economies, integrated into Belt and Road infrastructure, offered through Chinese-built payment systems, it shapes the financial architecture of nations for generations. If American stablecoins dominate, they extend dollar hegemony into every smartphone. If CBDCs prevail, governments gain new tools for both inclusion and control. The billion-person opportunity isn't just about finance. It's about who builds the rails that connect the developing world to the digital economy and what rules govern those rails. For the 1.3 billion still waiting to join the financial system, the race to build that infrastructure is an abstract policy. It's the difference between opportunity and exclusion. The choice ahead money has always been about trust. Trust that the paper in your wallet will buy groceries tomorrow. Trust that the numbers on your bank statement represent real value. Trust that the systems we rely on will keep working. Digital currencies don't eliminate the need for trust. They redistribute it. With a CBDC, you trust your government not just to maintain value, but to respect your privacy, to not abuse its unprecedented visibility into your financial life. With stablecoins, you trust private companies to maintain their reserves and honor their commitments. With cryptocurrency, you trust mathematics and distributed networks instead of institutions. Each choice has trade-offs: privacy versus convenience, innovation versus stability, decentralization versus efficiency. The system that emerges won't be decided by technology alone. It will be shaped by regulation, adoption, and ultimately by the choices billions of people make about where to put their trust. What's certain is that the banking system you grew up with, the one built on branch offices and paper statements and slow wire transfers, is fading. Something new is being born. The rise of digital currencies isn't a future prediction. It's happening now. The bank branch you pass on your way to work, it may not exist in a decade. The cash in your wallet, increasingly rare. The assumption that your money is private, that depends entirely on which digital system you choose. We stand at a crossroads. One path leads toward more government control over money than ever before. Another leads toward a decentralized financial system where code replaces institutions. A third leads toward private corporations issuing the digital dollars that power global commerce. Most likely, we'll get some combination of all three competing, coexisting and reshaping the financial landscape in ways we're only beginning to understand. What role will you play in the new financial order?